Welcome to Market Peeker. In today's video, we're covering two fundamental terms every Forex trader needs to know: pips and lots. If you're new to trading, understanding these concepts is essential for calculating profits and losses. Let's break them down in simple terms. First, let's talk about pips. A pip stands for percentage in point and is the smallest price move in a Forex pair, typically at the fourth decimal place. For instance, if EUR USD moves from 1.2000 to 1.2001, that's a 1 pip change. Pips are crucial because they help you measure market movement and calculate how much you're earning or losing in a trade. Now on to lots. In Forex, a lot is a standard unit of measurement for a trade size. There are different lot sizes you can trade. A standard lot is 100,000 units of the base currency. A mini lot is 10,000 units. A micro lot is 1,000 units. So if you're trading a standard lot on EUR USD, each 1 pip movement equals $10 in profit or loss. If you're trading a mini lot, each pip is worth $1. And with a micro lot, each pip is worth 10 cents. These values give you control over your risk. Larger lot sizes mean more profit potential, but also higher risk per pip. Here's a quick example. Imagine you're trading a mini lot on EUR USD and the price moves up by 10 pips. Since each pip is worth $1, you'd make $10 on that trade. If it had dropped by 10 pips, you'd lose $10. That's why knowing your pip and lot values is key for managing your trades effectively. To sum it up, pips measure market movement and lots define your trade size. Together, they help you calculate your profit or loss in each trade, so you can plan your trades with confidence.